The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there are thriving in these highly volatile markets that we find ourselves in right about now. My name is Mark Longo from theoptionsinsider.com, as well as many of the programs here on our ever-expanding Options Insider Radio Network. And I am joined once again by my boon companion, the yin to my yang, the dark side to my light side, if you will. Good old Don Schlesinger from the Volatility Exchange. Don, welcome back to the show, sir.
Well, I can see where the dark side might be an advocate of mostly selling volatility at times like this. I guess I'm glad I'm not on a trading desk in this kind of environment, because I imagine I probably would be having some sleepless nights.
You'd be very tempted right about now, I think, too, to hit some of these juicy bids we're seeing. And listeners will also be joined in progress by the Seabass, Mark Sebastian. As usual, he's running a wee bit behind. He should be joining us momentarily. So with the team mostly assembled, we will dive right into our volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we look back longingly upon the week's worth of action in volatility, and it has been indeed an active one from a volatility perspective. Just so our listeners know where we're sitting right now, we're recording this on Friday afternoon here around noon, 12:30 Central Time, and the markets are turning to the green after a sea of red yesterday. We're seeing the S&P up about 4 handles, the Dow had been down about 30 handles, now it's up about 6, and the NASDAQ up about 18, and the VIX cash following suit up about 0.47 to 41.82. So at least for the time being, the bloodbath seems to have ameliorated. We're not seeing the 10+% moves in the VIX and the 3 to 4% moves in the broad indices like we saw yesterday. But
have you looked at the gold volatility? Gold and metals are absolutely exploding today in volatility. GVZ and GVX are both up over 40 and are almost even with the VIX. Gold, silver being absolutely crushed. The story here today is people are rolling out of gold and rolling out of precious metals, and it looks like they're keeping it in cash, so they're in a position to buy this market when they pick kind of the bottom. All right, that's my best analysis of what we're looking at. Is it's not that the money's actually flowing into the market; it's that these guys are saying, okay, I'm taking my gold that I bought for 120, and I'm selling out before this thing starts, this bubble bursts, and then I'm going to be buying, I'm going to keep it in cash so that when we hit those flash crash lows, or when we hit 1,000 in the SPX, or when, the Greek crisis is resolved, I can swoop in with a bunch of free cash. It also is probably going to pay redemptions, would be the other thing. It may be a redemption story.
I'd probably lean on that. Yeah, a lot of people getting some redemptions, I would imagine, right here. Just so listeners know what he's talking about, we're looking here at a massive sell-off in silver, down about 15% or 5.5 handles to 29.61, and gold down about 5.5% or 9.2 points to 159, under 160. So the werewolves are upset today,
Don,
Mr.
you know
Sebastian.
who's howling about this sell-off? Werewolves.
Ah, right.
Silver bullets are cheap and plentiful yet again.
See, and in my day, we would have said the Lone Ranger would have been happy also.
Hi-ho, silver.
That's a little bit less, it's a little bit wasted on today's environment, but he used silver bullets.
Now you're just dating yourself, Don.
God, I was really proud of myself because for once, I actually caught Mark completely off guard. He had to stop. It was really, I was very proud of myself on that. Normally, I pull out some ridiculous joke, and Mark just plows right through it like a linebacker. But no, I got him right at the knees. I was very proud of myself.
I've become inured to your style over the past year, but that one threw me for a loop. That was actually a relatively good one. I'll give you that one. So, Mr. Seabass, aside from the massive bloodletting, when's the last time we saw SLV? I'll have to pull up a chart below 30. It's been a while.
It's been a long time since silver's been this inexpensive, and we haven't seen silver this low since like February.
Yeah, I just pulled it up. I remember having this debate with Uncle Mike on our other show back in that time frame around February, March, and saying whether the 30 handle was support or resistance for silver.
So you think he's backing up the truck here?
I think he's probably going to start rolling down those puts, even though he said he wasn't going to. I think today is going to be a low BBI day. Let's just put it that way.
You've got it. I mean, if you're looking at silver, with the way GVZ has exploded, now that by the way, this morning at you'll love this. This morning at about 9:30 Central Time, I wrote up for the street when gold was trading 163 that I thought it was going lower, and put on a back ratio, and was out of the trade at 12:15 this afternoon. Up 1 by 2, made $300 in 2 hours and 45 minutes. So I was pretty excited about that GLD trade, but.
Pays for all your downside in VIX.
Yeah, well, exactly. With the way gold has exploded here, though, and with the way GBZ has really moved, I think that we just saw the bottom of gold right here, at least temporarily. I think we're going to get a relief rally here for the next, at least out of the next day or two. I think we're going to see a relief rally back up to 161.
You know, it's amazing how dominant the metals have become in any discussion. They haven't quite usurped VIX yet, but they're getting there in terms of the consciousness and the attention of the masses.
It makes you wonder why that mini metals contract hasn't blown up the way we thought it would.
I think it's because their manager hasn't been handling their tour to quite the extent.
It is my fault. It is my. I don't know if you know this, Don, but I'm also manager of a little people band called the Mini Metals. Not sure if you know that.
Very nice.
Poor Don's is being dragged into the muck that is our option block history. But of course, we're talking about VIX here too, so let's talk about the week that was in VIX. And Don and I were just discussing about how if you looked at yesterday from a close-to-close perspective, it was a relatively benign day. And then if you look at it from an actual volatility or velocity of volatility perspective, it was an insane day.
Yeah, no, it was nuts. It was nuts. You know, it was just a classic kind of midday panic sell-off. And then we were this close. We were teetering on an all-out just destruction. It was pretty impressive. We literally needed about 4 more points in the S&P futures, and we would have been trading 1050 by the end of the day today. It got really scary there for a little bit. And if you look today, it's we're up today, but it's not like people are thinking that everything's safe. Going into weekend with the market up, VIX is flat. All right, folks, that means Vol's actually up about 1%.
Yeah, Vol has increased.
Yeah, so if you think about that, we're going to be coming in on Monday with a VIX at about 42.5. We actually yesterday the peak vol of the VIX was higher than the previous peak. volatility of the VIX options was higher than the previous peak implied volatility. There is hinting of another trip up near 48 to 50 on VIX. Would not be shocked. If we were trading like a Volex type contract, I think that the premium between what had already traded and what was going to be trading would be super high right now. So if there was a vol contract future on S&P, it would be the risk premium would be super juicy right here. Don, agree,
Sold
disagree?
to you. Sold to you.
Sold to me? Oh, yeah, no, I know. And it would probably be a sale. That doesn't mean that it wouldn't be there, right? Don, what do you think?
Well, that's what we were discussing a little bit earlier. And, we were talking about the historical levels of 1 month volatility and what the likelihood would be that such numbers could be sustained. And of course, the difference in trading VIX as opposed to trading something that settles to the actual realized volatility is that sentiment as to where volatility can be over the course of a month is sometimes a very different animal from what the actual volatility turns out to be. So when you're trading VIX futures, you're actually trading sentiment and trying to guess what people's guesses will be and what their forecasts were going to be. My point was that in looking at some historical data and vol cones and ranges, the concept of having a volatility that actually occurs and that is realized volatility of 42% for a month is really extremely rare. So that if you actually have the ability to try to trade realized volatility, if there were vol contracts on equity, or whether you try to replicate it through short straddle if you're a seller, were probably odds pretty strongly in your favor that this is unlikely to be sustainable over an entire month's period.
That's true, but the premium in one of these, a realized vol contract, my question, Don, was a little more specific than that. If you had let's say we're looking at the one vol on that expires in October, how heavy do you think the risk premium would be on a one vol in S&P 500 right here? How would you kind of evaluate that, just kind of anecdotally? What do you think we'd be looking at right here?
Well, I think that it's probably, as you say, at really stretched levels. We know that historically, when you go back over a tremendous amount of data, you find that the risk premium for equity, particularly the S&P, is very close to a 4% spread. And if you look at the graphs, you see that historically that gets stretched to larger numbers. It actually inverts where there are periods that realized volatility is actually higher than implied, but the historical average is about 3.7%, so very close to a 4-point spread. It is at times like this where in fact you might see considerably larger risk premium, where people are willing to take that VIX and those implied volatilities of S&P options up to levels that probably would be substantially more than 4% higher than what the actual or realized volatility turns out to be for the period that's being forecasted.
That's exactly what I was thinking. So it'd be pretty nuts. But yeah, but that's just speculation for now.
Speaking of the one vol and the three vol there, Don, we also like to dive into the dark, dark waters of Eurovol on occasion on this program. So what did we see over the past week in the three vol and the one vol on the Euro contract?
Well, I think I wasn't sticking my neck out too far, but we had that settlement price the night before we taped our show last Friday, and I think it was somewhere in the 1458 range or so. I jotted it, and again, I said, all things considered, I'd probably try to trade that to the downside, and then successive settlements, as I'm pulling up the chart here, were 14, 1379, 1220, sounded like I knew what I was talking about, 1270, turned around, and yesterday's settlement was 1587. I suspect that that'll immediately come back in again for today, but you need to be nimble in these things. So I said 1458 looked a little high to me, and we got down more than 2.5 handles during the week into the 12 range. But again, you can't sit around and count your profits for too long because they disappear while you're counting.
There's an old limerick I used to sing about this, Don. It was, Don, be nimble. Don, be quick. Don, make sure you manage your Eurovol contract candlesticks.
Very pertinent.
That's why you're the manager of the mini metals and not a performer in the mini metals. With that beautiful tune to close out the segment, we're going to wrap up our volatility review here and roll right into our mailbag.
Listener mail. Listener mail. Listeners write in.
And welcome to the mailbag. This is, of course, the portion of the show where once every couple of weeks we trot out the musty old mailbag and I open it up and I reach deep into the dark recesses of the bag and pull out what we have on the docket for this week. And we're going to kick things off with a question for you, Don. And it's actually a variation of a question we receive quite often in different ways, shapes, and forms about the vol contracts themselves. This one was actually posted in our forum by a user who goes by the handle Bullspread, and the title of his post was, quite simply, How Do I Trade Vol Contracts? And he writes, I've been listening to the show for some time and I've become intrigued by the concept of vol contracts. I think I have a decent handle on the differences between implied versus realized volatility. Well, that's good. At least you're listening to the show then and it's starting to sink in. And he says, I'm ready to take the next step. But that's where I'm stuck. How do I trade vol contracts? I don't see them promoted or even mentioned by many brokerage firms. If I call or email my broker, which he puts in parentheses is Interactive Brokers, are they even going to know what I'm talking about? Do you have any brokers that you'd recommend for their expertise with vol contracts? Also, since they are listed by the CME and track the realized vol of Euro futures, I assume that I will need a futures account to trade them. Lastly, he's got so many questions here. Lastly, are these listed on Globex so I can trade them electronically, or do I need to put an order into a pit? Thanks, Bullspread. And so, Don, quite a few questions there. And like I've said, we received many of those in various ways, shapes, and forms over the past few months. So it's good to finally answer them all on the show. So by all means, sir, let's answer Mr. Bullspread here.
Okay, well, in fact, as listeners probably know, and I would encourage you to continue to write. I'm always happy to receive questions on the forum. And as Mark has mentioned, I try to be very timely in my responses. So these particular questions that we're getting to today and that we're able to discuss on the show, I have actually answered in writing in both instances for the questions that we'll discuss, and we welcome your questions. Keep those cards and letters coming in. I answered this one by saying that, yes, there are several brokers, among them Price Group, RCG, and Advantage, who have been very supportive of vol contracts. Unfortunately, Interactive Brokers that our writer mentioned seems to be a little bit more conservative in their treatment of vol contracts, and their margin requirements have been what at least we consider to be rather unrealistically high. So they seem to have made an internal decision that they don't want to encourage the product. And while, of course, that's somewhat disappointing to us, that's their prerogative. But let's concentrate on the positive, and that is many of our listeners actually participated in the Price Group seminar that Mark Sebastian held a few weeks ago, very informative about the uses of vol contracts. And so Price Group is very actively supporting the product, and you certainly can trade vol contracts with them. I'm also told that RCG's margin requirements are actually half of those of the CME when it comes to initial margin. So you can certainly pursue opening an account there. And finally, I have a friend who actually asked me about the product, and he uses Advantage, and he opened an account recently and was told that he could trade the product with no problems whatsoever. So there surely are brokers out there who are handling vol contracts, and we're sorry for the moment that it seems like IB is not one of the champions, but there are other possibilities.
That's always frustrating to a lot of customers. We see this with a lot of products, actually, is that customers expect some degree of uniformity amongst the brokers when it's actually a brokerage firm by brokerage firm decision whether they list these products, what margin rates they charge on them in the options world as well as the futures world. Just a huge amount of discrepancy between one firm to the next. Just look at the ways they've all implemented portfolio margin, another good example of how they implement that across their accounts. There's a lot of discrepancy, I suppose you can call that, and that always tends to frustrate customers. They want to see uniformity across these different brokerage firms. So it's disappointing to hear that that's the case for vol contracts, though unfortunately not exactly unexpected.
Right, and as you said, the disappointment is that if you do other types of trades and you have an account, you kind of want it for ease under one umbrella and do it all with one firm, but it just may be that in this case you have to shop around a little bit and have a different account with a different broker if your particular one is not giving favorable requirements in the case of vol contracts. The other questions are very quick and easy to answer. Do you need a futures contract, an account rather, to trade them? And yes, these are futures contracts. They're regulated by the CFTC, and as a result, you would be opening a futures account in which to trade vol contracts. And then finally, are they listed on Globex so that they can be traded electronically? Absolutely. They're on the CME platform, and therefore they are electronically traded on Globex. So I think that answers the various parts of the question.
Some of these brokers, too, these days have taken extra steps to reduce those last hurdles you mentioned, too, about opening up a futures account. Some of these brokers have allowed you to essentially do it all under one account now. I mean, you have to open up the other accounts, but it's really kind of managed and interfaced by one account. And so that usually seems to take some of the fear that these customers have about, I have to open a futures account out of that equation. That'll make it maybe a little bit easier for Mr. Bull Spread. I'm not sure off the top of my head if Interactive Brokers is one of those. Of course, they're not really listing vol contracts up to spec anyway, so maybe you want to trade your vol contract somewhere else. But it's worth exploring some of these other brokers that do allow you to have these, I suppose you can call them one-size-fits-all accounts. All right, next up, we have a question that dates back to conversation Bob and I believe maybe even Mark Sebastian were having on the show a few weeks ago. This came through our forum as well, posted by a user who goes by the handle Athos, who is my favorite of the Musketeers, so I like this guy. The title of this thread is, "Are volatility cones irrelevant in this environment?" And Don, I can already see your blood pressure rising because he dares to besmirch the volatility cone. But we'll read his question and then we'll get into it a bit. But he writes, Bob Krause advocated the use of volatility cones on a recent show, and I know Don has discussed them in the past as well. However, Mark made an excellent point in a recent episode, and thank you, sir, that in this environment, vol cones may not be the best barometer for where you should work your orders. It got me wondering if maybe there were certain market environments where vol cones were extremely useful and other times, such as the current environment, when waiting for mean reversion is the quickest way to blowing out. Long-term capital immediately jumps to mind. I'm wondering what you guys think on this issue. I think I know where Mark stands, but I wonder where Don falls on this, since I know he is an ardent fan of vol cones. Keep up the good work, guys. And he is alluding to a conversation that I had with Bob when Bob Krause guest hosted for you a few episodes ago. I believe it was episode 20 or 21. And I believe Mark Sebastian was on that episode as well, and we discussed the ever-popular vol cones, and Bob had suggested something to the effect of he doesn't know why everyone doesn't just work resting limit orders on the upper and lower bands of the vol cones, because that's a perfect place to get your trades off, and 95% or so of the time you're going to be sitting pretty if you work those orders. And I happen to mention that, well, in this environment, at the time it was pretty crazy, and it's obviously yesterday, as we saw, it was still crazy. these are the times when mean reversion tends to not exactly revert perhaps as quickly as many people may want it, and you may end up being hit on some of these resting orders, particularly to the upside of that vol cone, and then being left holding it longer than you like, or perhaps being forced to a margin call by your broker while you're waiting for the mean reversion to kick in. So perhaps this is the time maybe to raise your resting order above the upper threshold of the vol cone, or perhaps just remove it entirely and play more of a wait and see game on this level, just because I'm a fan of systems, but I'm also a fan of knowing when perhaps to dial back the system for the edge case scenarios when the system tends not to perform as well. But Don, I'm sure you have an opinion on this as well. And ardent vol cone fan that you are, I'm sure you come at it from an entirely different perspective. So have at it, sir.
Well, not quite as entirely different as you might imagine, and I really can't find any fault with your answer, but I did answer rather...
I wanted a little bit of heated debate.
All right, we'll try a little bit.
Keep the listeners tuned in.
I did answer on the website, and I'll allow myself to shamelessly paraphrase from my response as I
quote from the best.
Pull it up here. I wouldn't say that I'm an ardent fan. What I would say is that I recognize the usefulness and the value of any analytical tool that might help us make decisions. I've always advocated that more knowledge usually can't be harmful, that trying to be smarter than the next person or better informed is never really a bad thing. What you finally do with that information, of course, is another matter. I think that one of the absolute givens for all of market trading, as you just pointed out, Mark, is that every concept or every potential idea or system or tool works sometimes, and no concept works all of the time. And, that's as it should be. So the big thing here is that vol cones describe history. And we all know that the securities industry law requires that we write on all of our literature that past performance does not necessarily guarantee future results or some similarly worded disclosure. So the first thing to understand is that because something may have been true 70% of the time or 90% of the time in the past, certainly doesn't mean that it will remain true 90% of the time in the future. And even if it did, it doesn't guarantee that this particular time, as you're contemplating doing a trade, that the 10% result rather than the 90% result won't be the one that pops up and bites you. So I guess what I'm trying to say is that it behooves us to study the past, but then to decide just how much stock we want to put in it going forward. And what you mentioned a while ago, Mark, is that there are two apparently contradictory features of volatility that come into play here and that we talked about before on the show. One is the mean reversion that the writer spoke of and that you spoke of. And the other is the persistency of volatility, the fact that it clusters. So over the short term, we know that anything can happen and that high volatility might even beget more high volatility or go even higher still, and that low may go even lower. But we know that in the long term, and asking me to define just what long-term means can be a tricky subject. But in the long term, we know that volatility is mean reverting, so that high reverts to an average or mean volatility, and low reverts also to the average or mean volatility. So bottom line, when you consult a vol cone, you'll learn where today's vol stands with respect to longer-term average volatility. And while that knowledge can help you make an informed decision as to how you may want to trade the current volatility and what the future may be like, it can't tell you what short-term volatility is going to be. And it can't tell you when you're going to revert to the mean. And my conclusion is that that's what makes life interesting. If it was always apparent what the right answer was, then everybody would want the same side of the trade, and there wouldn't be any trading. But I think it's important to keep into perspective that the term that I kind of sharply disagreed with in the post was, is a vol cone or is this type of analytical tool irrelevant? I don't think it's irrelevant. I think that there are times when consulting it might lead to a better outcome and a more successful trade than other times. But I don't think it's ever irrelevant to know what the past has been. If you were lying in a hospital bed in a coma and somebody woke you up and they said to you, what do you think the average temperature is going to be for the next month? You'd be pretty hard pressed to come up with an answer. So if they allowed you to look at the calendar and you saw whether it was July or January, that might help you to say whether the next month was going to be 80 or 30 in terms of the temperature. It doesn't mean that you're going to get it right, but it sure as heck would put you closer in the ballpark in terms of making a determination than if you were completely blindfolded and you didn't have any information whatsoever. So I can't see how having information could ever be irrelevant.
That's true. At the very least, it can inform you when you're selling your vol at far too low of a level. If you're looking at these vol cones and you're selling them well below the upper threshold in an environment like we're seeing yesterday and today, then perhaps you're giving away your risk at too little reward, and that's something that is also informative.
And it's a good point that you bring up, because we'll talk about Eurovol and the current levels of the contract when we go into the crystal ball segment at the end. I'll have a point to make about last night's settlement prices and future potential volatility. But in wrapping this up in terms of the vol cones, I consulted the vol cones for S&P volatility, for equity. And what I found was that going back in what we call the max history, as far back as our database goes, we take a look at the 90th percentile, which means that 90% of the time, 1 month or 3 month volatility, whatever you're interested in trading, would be below that particular level. And historically, for the S&P, that 90th percentile level is 25% annualized volatility. And of course, when you look at what the maximum has ever been for 1 month, you get some numbers that are off the chart. But when you go back and you actually look at those dates, you find that, of course, they were October of 1987, where for that 1 month, and because of a single day that we moved 23%, the vol for the entire month was in the 90% range or so. And more recently, in the period, end of November to end of December 2008, when that month's volatility, again, because of the extraordinary events, was about 80% for the month. But having said that, and having looked at closing VIX yesterday, which was 42, you can't find another 1 month period of volatility, certainly not in the last, 30 years or so, where for the entire month, equity volatility as measured by the S&P 500 was as high as this 42% is right now. I mean, when you say that the 90th percentile is 25%, I don't know what that makes 42 vol, but, for all I know, it could be the 99th percentile. So would consulting a vol cone be irrelevant in a decision as to how you may trade VIX futures today, or if there were a vol contract on equity volatility? I don't think you could come to the conclusion that it would be irrelevant. You might come to the conclusion that you better tread lightly here and be careful, because if we've once seen 80 and we've once seen 90 or 100, maybe this is the time for it again. But, this is for for everyone to decide for himself after having this kind of information at his fingertips. Is this another October 87? Is this another December 2008? Have there ever been other months where for the entire month we sustained 42 volatility on the S&P? And that's how you make your judgment. And you may know where I'm leaning, of course, but I'm not making recommendations as to what trade to make. I'm simply thinking out loud and saying that this information to me would be helpful. 42 volatility means that if you divide by the square root of 252, that rule of 16 that we use, 16 into 42 is more than 2.5. It's like 2 5/8. That's 2 5/8% movement on the S&P every day on average for the entire month. Well, I think we closed at about 11:30 last night. So if I whip out my calculator here very quickly, 1130 times 2 5/8%, it's just a shade under 30. So what you're saying is 30-point movement in the S&P every single day over the next month. Is that something that you're willing to bet on? Well, now listeners are saying, wow, you'd have to be crazy. Or maybe they're not saying that. But the point is, that's the kind of analysis that you have to make. Can we have 30 points in a given day? Absolutely. We just had it. Could we have 2 or 3 such days? Absolutely. Could we have 21 of them on average for the entire month so that we had 42 volatility for the entire month? Well, again, if you ask for my opinion, after all, this is Volatility Views, my answer would be highly unlikely. And, there's always the caveat, never confuse highly unlikely with impossible, because that's the way you can get into trouble. But, there's just the preponderance of the evidence. And as to how you want to fashion your trades and how you want to bet, I think this is a fairly tough environment for somebody to want to be buying volatility. So that would be my somewhat longer answer and expanding upon what I wrote on the website.
And that just illuminates that there is some definite value in the vol cones, if just to frame the argument and give you a frame of reference like you just did with the 30 handle a day move in the S&P. Once you break it down to those terms for our listeners, I think it brings into stark contrast what those numbers actually mean. Speaking of 30 handle a day move, I know in our recent show with you and Sinclair, we had discussed the close to close method of vol measurement versus the first time exit or the barrier method that he was proposing in his paper. And on a day like yesterday, you can see the relative merits of those two approaches starkly contrasted to each other. Because if you look yesterday, we had an enormous down day yesterday, an enormous move, and yet from open to close, we were essentially unched. The futures opened down. We had some vacillations during the day, and then we closed relatively close to where they opened. So from an open close perspective, it was a relatively moot day from a volatility perspective, but from a velocity of volatility from a first time exit perspective, it was a highly volatile day. So I think you can see just in a day like yesterday, the relative merits of those two approaches. And when you were talking about the 30 handle moves we could expect from this vol levels, it made me think of exactly what we saw yesterday and the different ways that we frame and view those movements with different tools.
Well, there's no question about the fact that the concept of intraday volatility and people who sit in front of a screen all day long and perhaps day trade and fast money as opposed to longer mentality position trading, that there's a very big difference. And it's certainly true that whereas close to close volatility doesn't always capture all of the flavor or all of the movement of intraday volatility, it is the industry standard in measuring volatility, and it's the way vol swaps and variance swaps are priced, and it does an unusually good job most of the time of capturing the majority of the actual volatility that takes place. And yet again, of course, there are exceptions. And something like yesterday, where, as you said, if you just looked at the morning, the first print, and then you looked at the close and you looked at the last print, the conclusion would be, oh, well, I guess nothing much happened during the day. And the answer would be, wrong you are. So there are always exceptions. It reminds me of a rather amusing joke. I'll take a very quick sidelight, a little bit of my gaming and casino background. A guy is in Las Vegas and he leaves his hotel room and he says to his wife, I'm just going to take $100, honey, and I'm going to play a little bit and I'll be back in a little while. He goes down, he plunks the $100 down on a number on the roulette wheel, and my God, it comes up and it pays him 35 to 1 and he's up $3,500. He goes over, he plunks it all down on the blackjack table, and he gets a blackjack and he wins 3 to 2 over $5,000. He's got close to $9,000. And now he says, what the hell, let me go over to the craps table. He goes on an extraordinary run, and he runs the $9,000 up to $50,000 at the craps table. And then he says, gee, I'm blessed. I have to keep playing. He goes over to the baccarat table, and he plunks it down on the banker's hand. And sure enough, he wins that too. And now his 100 is turned into $100,000. And he's ready to come home and go back up to the room. And he says, look, I'm blessed here. I can't lose. He goes over to the Wheel of Fortune, the big 6 wheel, and he plunks it down on the number 10, and they spin the wheel. And unfortunately, number 5 comes up. He goes back upstairs, and his wife says, how'd you do, honey? And he says, I lost the $100.
It's all about frame of reference. So
there you are, open and close. Start with 100, lose the 100, and just skip all the details in between.
I like it. Well, we actually have more questions here in the old mailbag, but we're running a little long in the old mailbag segment, so maybe we'll just do a quick answer on this last one. We got an email from Tim out in Portland who wants to know kind of a follow-up from a question we got a long time ago about sources of OTC volume. And he wanted to know, in the early episodes, Mark and Don mentioned exploring possible sources of OTC volume for the show. Have they been able to find any good sources for OTC vol swap activity, etc.? That would certainly be an interesting addition to the vol review. And unfortunately, Tim, the short answer is no. We've been looking, and I know Mark Sebastian has been looking as well, and we just haven't had a chance to really find anything that would be suitable to mention on the show. One of the reasons that people choose to go OTC. There are a number of reasons, obviously. They can construct unique contracts. They can trade exactly what they want. But one of the consternations for the regulators and the benefits for the traders is that lack of transparency, that lack of obvious oversight into how many contracts are actually going up. So finding a good, reliable source that would be comfortable citing here on the show on a regular basis is a little bit tricky, but we're keeping our ear to the ground and we'll see what we can find. But right now, there's nothing where I could say right now for certain, X trade went up in the variance or vol swap market, and this is correlated to X trade here going up in the VIX options or VIX futures pair. Nothing we've seen that has that degree of certainty yet. And Don, I'm sure you're probably in the same boat.
Yeah, I wish we could provide a more extensive answer, but it's just as we've talked before, kind of like in the shadows. These are not the type of trades and institutions that are plastered all over the tape and that are transparent. It's really one of the main reasons why we're so high on vol contracts and the whole concept of what we're trying to do, and that is to take at least the concept of vol swaps and vol variance swaps and be able to take that same pricing mechanism, that same formula, make it a great deal more accessible to retail traders as well as institutional traders, and get these things listed and transparent on exchanges.
All right, and that is going to do it for our mailbag segment. And now we're going to dive right into our crystal ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball. This is, of course, the portion of the show where we peer deep into our crystal balls and look into the ether of the future and try to divine what indeed is going to happen in the markets and in the terms of volatility for the next few sessions. And as we alluded to in the volatility review, is a lot of action on the metals front this past week, and then today, of course, as well. We don't normally dive into metal volatility, but we might have to start incorporating that into the show because it's becoming an increasing part of the trading landscape for a lot of customers.
Both vols have come in 2.5 points in the last while we've been talking. When you and I were talking, GVZ was over 40, and whatever the silver vol was blowing up too. GVZ is now below 39. GLD has turned around and bottomed off 58 to over $1.60. I think that we just saw a temporary bottom. I think we're going to get a nice pop back to 168 before this thing starts to take it in the chin again. I do think gold's going all the way back below 1,500. But, I do think we just saw a top in gold vol. VIX, as I said earlier, looks like it's pricing at the way it priced out its last move. When we hit a panic and then vols hit successively lower highs, that is a relatively bullish sign. Now, as we're going through that, when you start seeing vols start to hit higher highs, that is a very scary prospect coming off of a 48. I think we are going to hit 50 in the next 3 weeks. All right? It really, I don't like what I'm seeing at all. VIX hits 50. Realized volatility over the next month, I think, could be near 30%.
That's coming from a guy who's been short VIX for quite a while, folks. So take that with extra salt, or less salt, I suppose I should say.
I am currently long some vol short S&P, and I've got what I like to call my short-term, long-term trade. For those of you that can't, one of the things I've kind of messed around with in lieu of a time spread is, and we talked about this yesterday, is long straddles in VIX options and long XIV, the underlying, as kind of a synthetic time spread. And something like that is going to work very well for you short-term and long-term. So, traders, here's what I'd say. Premium looks expensive. It's probably still worth it.
Uh-oh. Buy premium on a Don Schlesinger show. Cover your ears, Don, lest they turn red. So you think a pop to 50 in the VIX, what does that correlate to for you on the downside in the S&P? 10.5? You going below 10.5?
Yeah, no, I think we could touch, what was the flash crash low? 10.10? Yeah, I mean, I think 10, in between 10 and a quarter and 10.50. That's probably where we're heading to, and that's assuming that we don't get some major systemic event. I've heard people talking about 800. I don't know if I buy that, but
the good old 800 puts always pop up in these discussions. It seems like they do,
but I would not be afraid to own the 1100s here. And I continue to be short long-term Vega, long Gamma here. I don't know how you would want to be anything but long Gamma right now.
It is a good environment for getting some hedges off. And Mr. Schlesinger, what are you seeing in your crystal ball in the world of Eurovol, sir?
Well, here's what's interesting. In view of everything that we've just talked about and the risk premium, unfortunately for our listeners, we're always like one day behind. So I'll comment on these opportunities that perhaps I am looking at as we record on Friday, and then when they'll turn on their screens and look at volex.us and take a look at the data section and these vol series at the screen that I refer to very often, they may find some different numbers. They may find that what I've spoken about has already resolved. But here's what's interesting. We're halfway through the front October 1 vol contract. Today will be 10 days into the realized volatility period with 2 trading weeks or 10 days to go. And as of last night, the partial realized volatility, the part that's been logged into the formula, was 12.72. Well, the contract settled at 15.87. And what that means is that for the remaining, it was yesterday, so 11 days, you would have to have 18 volatility on the euro for the remainder of the contract in order to justify that closing price. Well, just for fun, and because I knew we were going to speak about vol cones, I went to the euro contract and the cones going back as far as 5 and 10 years, and trying to see what the implications would be to have this kind of 18 volatility that was priced into the contract. And Mark was talking about it in terms of the risk premium and what it would be at this point for equity, for example. And I found that for both the 1 month and the 3 month, the 90th percentile was 15.1 or 15.2, meaning that 90% of the time, 1 month or 3 month volatility for the euro historically was less than 15%. That was over 5 years. Over 10 years, that 90th percentile was even lower at 13%. And here we are looking at a contract that settled at a price that would imply that we were going to have high 17s or 18 volatility over the life of both the 1 vol and the 3 vol. So again, I'm not saying impossible. You learn that you never say that, but I would say highly unlikely. So yet again, on a settlement price of 15.87, and we're recording at about 1 o'clock Chicago time, 2 p.m. in the East on Friday, I'll stick my neck out again and say that that number's going considerably lower.
And just to wrap up as we're closing out this episode, looks like we're still heading to the north here in the markets. Dow's up about 70 now, S&P up about 12 points, NASDAQ up about 34, and the VIX cash has finally started to sell off down to about 41.22, down just a little bit, about 1/10 of a point. But looks like the upside is continuing. Perhaps all that precious metals money is funneling into the equities. But that is going to do it for this episode of Volatility Views. I want to thank Mr. Sebastian for joining us today, and listeners can always surf on over to optionpit.com to find out more about what he has going on over there. And also, I like to thank my boon companion, the yin to my yang, good old Don Schlesinger from the Volatility Exchange. And Don, before we go, is there anything fun or new or interesting going up on volex.us that you want to let our listeners know about?
A quiet week this week. I don't think we've had a lot that's new, but yet again, working on getting all this information that historically is logged onto Bloomberg for all those who use the Bloomberg terminal. So as soon as that's all available, we'll let everybody know.
And listeners, they should also be aware that we are going to be doing a live Volatility Views coming up at the Futures Industry Expo here in Chicago on October 11th. We'll have a 2-hour block on their stage there, right in the heart of their Taste of Expo reception. So it'll be a very, very popular time to be down there. Free drinks will be flowing everywhere. And we're going to be doing the option block at 4 p.m. And then at 5 p.m., Don and the rest of the gang will be taking the stage, and we'll be doing live Volatility Views. So if you'd like to come check out the show live, that will be your chance. Just surf on over to futuresindustry.org to check out the links for the show. I know we're working on getting some complimentary passes for our listeners to the expo hall. You guys over at Volex, are you guys exhibiting at FIA this year?
Yes, absolutely. We'll be there for the second year. Happy to have listeners stop by, chat with us, and it'll be great to see some of the people who've been writing in face to face.
All right, that is going to do it for this episode of Volatility Views. I want to thank all of our listeners out there for downloading and streaming and subscribing to the show and making it such a hit. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.